Good morning, everyone. Welcome to today's Phillip Securities Research Morning Call. Today we have a few stock counter updates. For results-wise, we have Zixin, BRC Asia, and ThaiBev. For Phillip on the ground, we have Skylink, Far East Orchard, as well as UltraGreen. For update, we have Geo Energy, and we will end off the session with the usual SG Weekly for week 49. Kindly note that Zane is on leave today, so we won't be addressing any TA questions. This is the usual disclaimer slide. Kindly note that information presented is solely for educational purposes and should not be treated as financial advice. Without further ado, I'll hand over the time now to Serena. Thanks.
Hi, sorry. Iqbal, can you go presentation first? There's a construction here. I need some time. Sorry.
All right, sure. Yeah. Sorry for the confusion. Yeah, I'll be presenting on BRC Asia's full year 2025 results. Yeah, so for BRC Asia, their second half 2025 result is within our expectations. Um, for their adjusted PATMI, it spiked by 36% year on year. So as you can see in the table on the left hand side, the second red color box, there is the adjusted PATMI. So we strip out any gains from disposal as well as acquisition. And it for the second half results, it increased by 36% year on year. So for the row right above the second red color box, that is the PATMI number. So I think you have seen many of the mainstream media reported that the net profits dropped by 5% year on year. And this is because there was a $16.5 million disposal gains on associate in the second half of last year itself. However, if you strip that out, the adjusted profits gains for the second half is 36%. And this is being driven by higher delivery volumes. So we estimate that there is a 34% year-on-year increase in steel rebar delivery volumes in the second half of this year itself. And that's been driving the adjusted PATMI growth. As you can see in the chart at the bottom left-hand corner, the red color line shows the estimated delivery volume on a quarterly basis, and then the blue color line is the revenue growth, and the dark blue color line shows the steel rebar pricing itself. So for the second half of this year itself, there's been a drop in the steel rebar price. However, because of the increase in delivery volumes, plus 34% year on year on a quarterly basis, this drove the revenue increase for the second half of this year. In terms of balance sheet, BRC Asia also reported a stronger balance sheet because of a 40 million higher operating cash flow generated in this half itself. So they are able to pay back a lot more, 24 million higher debt repayment. As for the negative, the steel rebar prices are still falling. We estimate it fell about 14% year on year. However, the volume expansion is able to offset this fall in steel prices. As for our outlook for BRC Asia, we do think that their strong order book of $1.9 billion is expected to drive delivery volume ramp over the subsequent quarters. This is because last quarter itself, they won a $570 million Terminal 5 contract. And we do think that this will be one of the main driver in 2026 and 2027. We do think that BRC Asia will be able to achieve peak volume in terms of steel rebar delivery, driven by the execution of Terminal 5 contract. That's the first main driver. Second main driver will be the HDB BTO build-up, because the government has been ramping up the build-up of HDB BTOs. Another driver will be MBS integrated resort expansion, because we do expect MBS to tender out the integrated resort contracts by this year end to main contractors. And because BRC Asia has a 60% market share in steel rebar, we do think that it will flow down to BRC Asia when the main contractors tender for the raw materials. So we do think that this will contribute to an expected peak volume in the next 2 years. Hence, for BRC Asia, we upgrade to buy from neutral. We raised our target price to 5.1. Previously, it was 4.1. That's because we raised our next year's adjusted PATMI by 15% because of the higher delivery volumes expected, as well as because we roll over our valuations to the next 2 years. Yeah, so that's all for BRC Asia. I'll hand over the time now to my colleague.
Hey, thanks, Iqbal. Yeah, so I'll be doing Skylink. It's a Phillip on the ground. So I'll just go through some brief background on what they do. So the Skylink Holdings Limited, they are a one-stop customer-centric commercial vehicle specialist. So they offer three main products, right, or services, I would say. It's firstly vehicle leasing, hire purchase financing, and engineering services. So they do have other services as well, but it's not part of the listed company. They also do trading of motor vehicles, rental, for passenger vehicles, and insurance as well. But their listed company focuses mainly on the commercial vehicles. So in FY25, their revenue grew 76%, mainly from fleet size growth, so it more than doubled, and also their loan book growth from 60.5 million to 66.4 million. So just go through each of their revenue streams. Firstly is leasing. So this is their largest revenue contributor, but the margins are not as high as the other two. It's around 17% gross margins. So they own and operate a large fleet of commercial vehicles. This includes like vans, light goods vehicles, heavy trucks, and they lease it to businesses for their transport and logistic needs. And a lot of this is leased back to, and their main customers are SMEs, so small and medium enterprises. So it can be anywhere from, you just need one or two vehicles to like maybe 10 or 20 kind of vehicles. But majority are the smaller businesses. And their second revenue stream would be credit. Why? So they also offer financing for customers who take on who want to get a vehicle or want to lease a vehicle. So it's really end to end, and then this contributes around 14% of their revenue, but the margins are much higher at around 55%. So what they do when it comes to the financing solutions is that they take a loan since they are a company, they take a loan from the bank, and then at a lower cost, I think it's around maybe 3 to 5% kind of interest, and then they lend it to the customers they up it to around 7 to 10%. So their margins are around 4 to 5%. So that's why their gross margins are quite healthy at 50%. And the last revenue stream, and what we believe is also the fastest growth driver for them, would be the engineering. And this engineering is mainly doing the maintenance, repair, and overhaul, or MRO. Right? Currently, it's only around 14% of revenue, so similar to the financing one, but the margins are also quite healthy at 40%. So they do they do painting, they do repairs, for all their customers. So it's really an end-to-end where firstly you get the vehicle, you can also finance it, and then if you need any help, you can also repair it. So that's why they call it end-to-end. As for their guidance, they provided some profit guidance, net profit guidance of around 7.3 million for both FY25 and FY26. So in FY25, they really achieved around 2.74 million, and in FY26, the first half, they got about 1.8. So that leaves us with 2.8 million for the second half of FY26, and they're quite confident of getting it, mainly from a huge increase from the engineering segment. So the guidance is that it will contribute more moving forward to around 25 to 30% of earnings from 20%. So it's quite it's a 10 percentage points kind of increase. As for the outlook wise, we believe that the fleet size and loan book growth will come from markets of consolidation as they absorb a lot of the smaller players because they find it very hard to compete, and also some targeted M&As which will help to boost their growth. And for their financing or credit segment, it's the delayed effect of the lower rates will actually benefit them. So what I mean by that is that the rates are going down, so the banks will offer a slightly lower rate to Skylink, and then they will still be able to keep that interest rates that they have been offering to customers, around 7 to 10% for at least the next 6 to 12 months. So this is how they will be able to benefit from these lower interest rates, at least in the short term. And last but not least, for the engineering segment, why we believe that is the fastest growth is because they have 2 new tenders, quite big tenders. It's to a main bus company and also to a food and beverage company. And this will help to support their earnings contribution. And what we believe is that if this too is successful, right, then these customers will want to give the contract or the tender back to Skylink again for their other bus outlets or their other centers. So that's all we have for Skylink. We don't cover them, so we cannot provide a target price or rating. Yeah, so I'll hand it back to I think I'll hand it back to Serena. Yeah, for Zixin. Thank you.
Hi, everyone. I'm so sorry. There's suddenly a construction started when the webinar started. I'll speak up. Sorry about this. So good morning, everyone. I'll present Zixin first half financial year 26 result and also the site visit update. Next slide, please. So the first half earnings were actually below our expectation. So the revenue and net profit were actually 41% and 29% of our financial year 26 forecast. The revenue actually up 40% year on year to 220 million renminbi. This is driven by strength in all business segment, but the net profit actually slow growth at 3.9% year on year because of the higher income tax and also research and development expenses. So for the positive, we actually see solid growth in sweet potato seedling and also processed product segment. The processed product segment actually grew around 68% year on year. This is driven by increase in sales and also the production volume. There was a more than 40% growth in sales volume because the company actually just launched a new sweet potato crisps product and the higher production capacity because of the new high technology manufacturing facility. And then regarding to the sweet potato seedling segment, the revenue actually grew around 500% because of an increase in the external sales. Because the company actually expanded their seedling nursery by 100 more, and it actually helps with the capacity to boost the capacity. But then in terms of the negative, the gross margin actually declined 300 basis points to 30.2% because of the higher raw material cost. In this case, it refers to sweet potato in the processed food product segment because the sweet potato price actually increased around 4% this year because of the recent typhoon in China, which actually negatively impacted the supply. And processed food product segment actually accounted around 70% of the overall Zixin's revenue. But moving forward, we do expect the gross margin to improve slightly to 31.5% in the financial year 26. This is supported by two things. The first one is we do expect a higher fresh potato output because the harvest season actually started in August. It will all the way until early February. And the second thing is we do expect some increase in production volume of high margin processed product because of the new facility, like I mentioned before. Currently, they have yet to reach optimal utilization. And lastly, the earnings from the fresh sweet potato segment actually declined 39% year on year, even though the revenue actually grew 16.7%. This is mainly due to an increased trading of fresh sweet potato in first half under a supply constraint, which actually will make Zixin requires to buy more produce from other farmers at a higher price, even though there is a higher sales volume and revenue from seedling since they are from cultivation and supply segment. And moving forward to second half, we do expect the growth of Zixin we do expect the growth for Zixin to be driven by three main reasons. The first one is the higher fresh sweet potato production during the harvest season. We do expect that once the production get increased, it will gradually stabilize the average selling price. And secondly, we do expect some of the improved efficiency in processed product lines because of the new manufacturing factory. This is why for this business segment, we actually raised our revenue forecast by 10%. We do expect a 41% year-on-year growth for this business segment because of the higher capacity, leading to a better production volume and also a stronger revenue contribution for premium processed product, particularly the newly launched high-margin premium purple sweet potato powder, which I will explain more in the update presentation. And the last revenue drivers, we think that there will be some small contribution from sweet potato trading activities in Hainan. And in terms of the valuation, we actually maintain a buy rating, but we lower our DCF target price to 0.055 from 6 cents. There is a recent exercise of option by major shareholders. So they increased the outstanding shares by 21.5%. In terms of the forecast for financial year 26 net income forecast, we actually reduced it by 13%. This is because we do expect there will be a higher effective tax in the processed product segment, and also we still believe that there will be a higher sweet potato pricing in short-term basis. But in terms of the revenue, we actually increased the forecast by 7%, even though in first half is only hitting 41% of our forecast. But first half is normally seasonally weaker because it's the non-harvest period. So we do expect the demand for the processed products will continue to strengthen because of the upcoming holiday season, including like Christmas and also Chinese New Year. And we do expect this harvest period actually improves the supply. Yeah. And next slide, please. Apologies for noise, so sorry about that. So I will be sharing some key insights from our site visit to Zixin Group operation in Lianchun last week. So for those who are unfamiliar with the company, Zixin is actually a biotechnology-driven sweet potato company with an integrated value chain. So they have from seedling production to crop cultivation to food processing and also waste recycling. So for the near term, we do expect smart warehouse to stabilize the fresh production. So in Lianchun, the harvest season, like I mentioned before, actually runs from late August to early February. So instead of doing the post-harvest processing themselves, Zixin actually use a smart warehouse partner that handle the entire post-harvest process, including like curing, cold storage, automate washing, sorting, and packaging. So when the farmers are actually harvesting the sweet potato, sometimes it will accidentally hurt the surface of the sweet potato skin. If you continue to let it be, it will spoil very quickly. So this is when the smart warehouse came in, and it currently equipped with a 3 temperature control curing facility, which you can see in the bottom right, the figures in the bottom right that shows that this is the curing facility. So the entire curing process actually takes 15 days, and it actually serves 2 main purposes. The first one is that it will convert the starch to natural sugar, which will help to improve the sweetness and also texture. And the second, more important one, it will heal the cuts and bruises of the sweet potato skin. So it will help to strengthen the sweet potato skin and also extend the storage life. So after the curing process, the sweet potato will actually be moved to the cold storage. So when it's needed to sell, the warehouse will actually proceed with the packaging process. So this entire technology will actually extend the shelf life of sweet potato from 1 to 2 weeks to up to 6 months, so that throughout the year, Zixin can actually better manage the supply flows and implement a more effective pricing strategy, because the production will be more predictable for them. And the secondly is that we do believe that another short-term catalyst actually lies on high-margin premium processed product. So currently the Lianchun food manufacturing facility actually received a halal certification from Indonesia. It will be beneficial in Zixin plan to export halal certified snacks and also convenience food to the country. Currently, there will be selected product will be launched soon for the Indonesian market. So one of the notable product that we see, like mentioning, is actually the premium single cell purple sweet potato powder. It's actually produced with Zixin pattern cell attraction technology, which the figure, I mean, if the figure from the top right, it will shows the machines. So instead of unlike the conventional milling method, this process actually maximizes the nutrients retention. This is why it makes it very ideal for comestic and so food supplements. So Zixin currently can produce around 5 tons per day, and they're actually targeting commercialize it by March 2026. And then in terms of pricing, it's estimated to be sold at a premium price of around like 30,000 per tons compared to the normal ground sweet potato powder is currently around 8,000 per ton. So there's a 280% of premium price because of the quality. So that we think that once, let's say that this product actually fully commercialized, it could be another main revenue contributor to the business segment. And then for the long-term growth catalyst, we actually do see opportunity in expanding seedling cultivation. So in the bottom left, that you can see that this is the seedling nursery. Like I mentioned it in the result update, the seedling revenue actually grew about 500% year on year in the first half. This is driven by a strong demand for the premium varieties, such as the varieties like Hong Yao and also Silky sweet potatoes. And these varieties at the moment can be sold around 45% higher than the standard varieties. So we do expect the demand will continue to stay strong for the next 2 years. And Zixin is currently planning to expand the nursery capacity by 100 more to 300 more by financial year 26. This is in order to boost the seedling production of premium varieties that will be beneficial in revenue growth of the cultivation and supply segment. And besides Liancheng, we also believe that the full commercialization of Hainan project also offer a major long-term growth opportunity for Zixin, so that Hainan can actually expect support 2 harvests per year compared to Liancheng's once a year because of the weather. So that it could possibly double a fresh sweet potato production in the future. At the moment, is in the first phase where we're focusing on sweet potato trading. It's a thinner margin, but it could be quicker for production because it requires less preparation time. So therefore, we do expect a small revenue contribution from this area in the second half of the year. But over the long-term basis, the ultimate goal is actually to replicate the fully integrated value chain like they have in Liancheng to Lingao County in Hainan, because it provides around 5 times the planting area available compared to Liancheng. So once the capacity expands and also the processing infrastructure started to roll out, we do expect Hainan is positioned to become a multi-year growth engine for the group. And that's all for me. So sorry for the noise. Thanks very much. I'll pass the time to Darren, I think.
Yeah, thanks, Serena. Yeah, run through Far East Orchard Limited's Phillip on the ground based on their FEOR 30 strategy. So they came up with the strategy for 2030. So if you do not know Far East Orchard, there's a real estate company. So they have a strong focus in the lodging. So they have PBSA and hospitality. So they operate a lot of hotels. So for the strategy, basically they have a target to grow by 50% in AUM for core assets. So the AUM currently is 2 billion. They target to grow that to 3 billion, as well as to increase the number of rooms owned or managed or operate. So now it's 22,000. They target to increase it by 50% as well to 2030. So that is basically the FEOR strategy. So they also, on top of that, they also plan to divest some non-core assets. So if you take a look at the top right-hand corner, so the top right, the non-core assets is number 3. So there's the medical suites, Wood Square, Orchard Rendezvous Hotel, the land. Yeah, so the land for is the biggest one. So that has about 500 million or close to 500 million value. So they are looking to divest that, but for that's a little bit challenging as the value is relatively high and now it's currently leased to FEHT. Yeah, and they also plan to divest lower yielding assets. So they could possibly divest that and use those assets to seed the funds also that they are planning to grow. So they are planning to grow their fund management platform. Currently is 20%, or currently is the contribution is insignificant, but they target to increase that contribution to 20% of profits from fund management. And other than seeding funds, they're also actively looking to expand the hospitality. So they plan to grow their presence in Japan. So that is the near-term focus. In the longer term, they are planning to expand into Southeast Asia like Vietnam and such. But that is 3 to 5 years out. Like in the near term, like within 1 to 3 years, the main goal is to grow Japan and the PBSA segment as well. So for PBSA segment, they plan to or rather they expanded recently through the acquisition of Home for Students. So currently they own a 84% stake and they plan to increase that to 100% by 2030. So Home for Students is a PBSA operator in the UK. So they are the largest private operator in the UK with over 50,000 beds. Yeah, so basically for the AUM growth, currently it's 2 billion. They plan to increase it to 3 billion. They plan to do that through expansion into hospitality, PBSA, and so like I mentioned previously, and as well as possible BTR, which is built to rent, and co-living. So that BTR and co-living is in the longer term. Yeah, but near term is still the PBSA and grow the hospitality in Japan. Yeah, so basically for them, the outlook, they're trying to be like capital land as well. So many of these real estate companies trying to be asset light and to have a fund management franchise to build the fund management franchise to receive recurring income as well. So FEHT is also, sorry, Fires Orchard is also trying to do that, to build this model. But for this Fires Orchard 30 strategy, we think that some key points are missing. So one of it is their dividend policy. They did not come up with any clear dividend policy. So they mentioned that the dividend policy will be dependent on capital needs going forward, and they did not commit to any target dividend, not the payout ratio, neither or a fixed absolute dividend payout as well. So basically, no commitment there. We think for the share price to really rally, there needs to be some like catalyst, or like for instance, when they divest assets, they do need to return some money to shareholders in the form of special dividends or a higher payout ratio, but that wasn't indicated. And they also have no plans to buy back any shares for now. So right now they're trading at over 50% discount to NAV. So we think that if they come up with this more fixed dividend policy or perhaps plan to buy back shares, this discount to NAV could be narrowed, as well as the fact that the NAV per share itself will be improved with the fact that they buy back shares. Yeah, so the last 2 points that I mentioned were kind of very unclear, like no clear dividend policy and plans buy back shares. So yeah, that is our view for Fires Orchard Limited. Yeah, thanks. Hand over time now to Paul.
So on the new UltraGreen.AI, I'm not sure why is it called AI, but I think it's Ultra. Next slide. Okay, so for this company, the market cap is about US 1.6 billion. Going to be listed on the 3rd. The valuations, if you assume 60 million, I think about 20 odd times PE FY25. We don't have a forecast. We just analyze the first half results, which was 50 million, which was 25 million, but had several one-offs. So we just kind of analyze it of 60 million. Then that's the kind of valuations you get. So what they do is I mean, 99% of us won't know, but I mean, they fluorescent guided surgery. So what they do is they provide the powder where the hospital will mix it with water, and then you actually inject it into the body, or where you will illuminate the healthy parts of the tissue. It goes in the bloodstream, and from that it can detect the healthy parts. This will assist the surgeon in their surgery. Right now, it's being used. So I'm running all over the place because just to explain, it's quite a complicated business. So what is being used now is in certain in what do you call it, in colon surgeries, gallbladder surgeries, and also used a lot in ophthalmology to assess the eye. So the bottom part here you see is the earnings, first half of 26, but there's some one-offs. So what they're going to do is they plan to move this from just these few surgeries into many more surgeries. So the positives of this business is number one, the gross margin. So the gross margins about 80+%. They sell each vial about $150 to $200, and the cost is about $20. The second thing is it has become like a standard in many of these procedures, like gallbladder procedure, colon procedures, and also what they call it, for the eye procedures. Yeah. So the future for them is to move into emerging, is especially cancer procedures. So that's the second positive. It's a very high growth business, high margin, high growth. So speaking to some in the industry, they can't assess the technology, but what they do say is that a surgeon, if this becomes the standard, a surgeon most likely will use their procedure since it only costs $200, and also to protect them from insurance. Because if you don't use this procedure and there's some issues, then I think you'll probably be subject to higher legal suit. But with this, at least you can just say that the bad tissues weren't really reflected in this. I mean, that was one feedback I got from those in the healthcare. But again, this is just one or two people. Yeah. But anyway, I think the growth rate is going to be strong. It's quite impressive company because it's a global company. They're in 50 over countries. And yeah. Okay, next. Move on to Thai Beverage results. So Thai Beverage released their second half results. There were external shocks that impacted the business, which I'll explain later. Next slide. So if you look at the results was below expectations for the full year, 92 and 86 instead of 100, of course. The second half, the spirits business dropped 3%. So spirits is the main profit contributor for ThaiBev. So spirits is the white spirit, brown spirit. This is mainly like 80-90% of the earnings if you look at the table on the left, in the red box. The positive was the beer business did well. So if you look on the left again, the earnings jumped a lot. And because they recovered quite strongly, and also the negative was the weakness in spirits, which actually fell very sharply by 11%, the volumes in fourth quarter. So let me just go to the second last bullet point. So what are the external shocks that hit their business was the border dispute with Cambodia. So because of that, there was a huge number of Cambodian migrant workers that left Thailand. The numbers range, I mean, is from 700,000 to 900,000. I mean, no one has the exact figure, but these were actually Thai Beverage's biggest customers, especially for their lower price white spirits. And also because of all the border disputes, there was also caution in the supply chain, in distributors bringing the product up north. So that has hit them. The second thing that's going to hit is of course in Vietnam, which is all the typhoons and floods. So for us, we still maintain our accumulate. We actually cut our FY26 earnings. We're probably too aggressive in our FY26. We cut the price to 53 cents. Our valuations is based on 12 times, which is their 4-year average, which is cheap for a consumer product company because they have like 90% market share in spirits business. But of course, the earnings has been sluggish. So this stock used to trade at 18 times PE, now traveling around 12 times, which is lower for a consumer company. In terms of the outlook, we think 26 will be a recovery year. Firstly, the first reason is mainly margins are going to expand. So we think at the OPEX line, I think Thai Beverage is very good in cutting costs, especially if you have a business that's already 90% market share. So I mean, no need to go and promote. I mean, everybody kind of knows your company, so knows your brand. So we expect them to do that. Because the volumes dropped very sudden for spirits in the fourth quarter because of the border dispute. The second thing is gross margins. So they highlighted that gross margins is going to expand very likely because packaging cost is down, aluminium corrugated box, malt cost is also down, molasses price is also down, which is a sugar base, which is their brown spirits is like a rum, so they use that for their spirits business. It's all sugar based. So these two reasons could actually give the pickup. The one unknown is, of course, all these external shocks. So they are operating in the weak consumer spending environment. And of course, with the floods, especially in Vietnam, the near term could actually impact top line, but I think margin expansion should help them grow again in 2026. Next slide. The next is Geo Energy. So Geo Energy, which is a core producer, they gave a third quarter update. The earnings was hurt because coal prices dropped to 40, but I think now rebounded to $48. Next slide. So the results was below expectations. I mean, over 9 months, the earnings was only 56% of forecast. The positive is the production ramp. So the production, which is the only controllable thing they can do, is they actually double their production, about 1.7 to 3.4. If you look at the sales. And if you look at I think there's in terms of the weakness was the selling price. The selling price actually dropped 18% to $40. So as a result of that, the cash profit margin per coal dropped 45. So that's why the earnings PAT dropped over 50%. And so in terms of outlook, we actually maintain our price because we do see coal prices recovering quite strongly. So that's why we are keeping our target price valuations all intact. But the key thing is, of course, as mentioned before, is the 92-kilometer road and jetty, which costing them almost $200 million. So this is 190 million is before construction costs. So you add in all the consultant fee, interest, is almost $200 million they're going to spend on this. So the road at that point in time, September, is 50%. So probably by now it's probably 60% completed, and we should help to compete by middle of next year. So why this is important and makes 2026 an interesting year is that once the road is completed, they can ramp their production from 11 million this year to eventually 25. But not 25 will take maybe 2-3 years. Probably the first year maybe 12. That road alone will be 12 million. So it takes some time, but eventually they're going to hit the 25. So that's the first driver. The second driver is that they will collect a new stream of earnings from the additional 25 million road. So this is a 50 million road capacity. So the additional 25, you assume $6, $5-6. So this is like, almost pure profit kind of revenue. The third thing is, of course, they recently acquired the Tuck and Barge, so they can also generate earnings from that. The fourth thing is that before this thing occurs, they're probably going to announce news of an off-taker for the road, and then even sell a bit of the stake in this road and jetty infrastructure, so that at least to monetize and to show the real value of it. But of course, to also get proceeds from it. So hopefully, first half will be interesting because all these catalysts could actually happen. Next slide. So so this just to show the bounce in coal prices. Sorry, a bit hard to see, but it 40 then went to 48. Of course, when the Russian incident happened, you notice the coal prices spiked all the way to 130. The reason why coal prices is improving is also because production is being curtailed. So production is contracting in China. If you look at the green line compared to the red line, so the green line is down compared to the red line. It only started in the third quarter, so you feel the hopefully improving prices all the way to the fourth quarter. Next slide. So I'll move on to our usual weekly. So in terms of the data points coming up from Singapore last week, I think Singapore economy actually looking very robust. Industrial production, I have no idea why, but industrial production spiked up almost 30%. And this follows on also a very strong September. Electronics 26, and so exports also show a similar spike in growth. So I am actually not really clear what is causing the big bounce, but it's very good. It's very positive for Singapore's fourth quarter GDP. Loans is also very strong. So loans is also still growing about 6%. It's still stable, but if you compare that to October of last year, loans growth last year was only 3% October. So right now, loans growth in Singapore is double the pace. And the third point is that this loans growth is well supported by deposits. So it's not like the banks are stretching their liquidity. There's ample deposits coming in to support these loans because deposits are it. Of course, the other hot area in Singapore is, of course, new home sales. October sales jump, I think, 200%. Of course, this can be volatile month on month because September was down. But year to date, new home sales is about 170,000 year to date. So you're tracking about 13,000. This is probably like close to the record that hit, not all time high, but I mean the recent record of 14,000, I think. In the US, we got some news on retail sales, so nothing to worry. It's a bit slower, but still strong, I mean, 4%. And then PPI, no red flags here in terms of spike increasing inflation. Next slide. So I'll move on to our tactical views. We'll show more slides later, but we will just to look at Singapore's performance in November. The market was up about 2.2%. 7 months of gain. So Singapore this year is up, I think still about 20%. I'll show you the chart later. But the big gainers in terms of the big large cap ones was Jardine, Matheson. I think the whole Jardine group being re-rated. Singtel is up about 11, and then OCBC up about 8. Jardine up about 11. Our model portfolio was virtually flat. I mean, yeah, but year to date, it was up about 38. I'll show you the chart later. In terms of the news, Citrum was in the news last week, so let us just give our, we don't cover, but let us give our top level view on it. So year to date, they secured only 2-3 billion of orders, and this can't match their revenue. I mean, you're talking about 10 billion, so it won't be enough. So they're depleting their order book. Secondly, speaking to industry, I think there's always the risk that they won't win, although low probability, but I think that there's always that risk that they might lose a Petrobras vessel to the Chinese yards, which are bidding aggressively. And the third is, of course, there's the overhang for Seatrium. There is the Maersk write-off. So Maersk ordered a vessel. They didn't disclose the price, but ordered a vessel, paid 20%, then only pay the 80% by January next year, but they actually said that they don't want the vessel anymore. So there's an arbitration case. But no, there's a risk that Citrum might make a write-off on this. Then, of course, we're also very cautious on Citrum's model. The market is expecting better margins, but I think the whole Citrum model now is just to do outsourcing, not manufacture anything, just project management, do some Lego assembly work, and that kind of hurts you because if you don't do most of the manufacturing, or the margins will go to other players. So in terms of our final tactical view, we think the sentiments are, of course, very cautious now because of all the AI worries, and the technicals look fragile, of like possible head and shoulders for the US market. So the market might move sideways in this cautionary tone, but this week they're going to have quite a bit of news, so you could watch the volatility because there'll be 2 job announcements, although it's not the official US payrolls. You have these JOLTS and ADP, if you look at the bottom here, and then you got one inflation reading, and then you have Powell's speech today later in the US hours. So all this is going to affect the market expectations of a rate cut. But right now, market probability is at 83% of a rate cut. We are also expecting a rate cut of 25 basis points. So this hopefully happens to carry the market. Otherwise, the market kind of looks a bit fragile. The Fed rate decision is on 10th of December. So some of the events coming up will be the Powell speech, like we mentioned, Salesforce results, retail sales, and of course, also the core PCE, which the market is expecting 2.9. So long it doesn't move too far away, I think the rate cut is still on track. Then on Wednesday, we'll have Manulife. Then Thursday, we have the new IPO soon, Hawk, and then Her and Marco Polo. It's open to anyone to attend. Next slide. Okay, so ignore the red dots. The red dots is just when the government announce measures. But if you look at this, you notice that the new home sales, not wholesale, sorry, there's a typo. New home sales is up, is skyrocketing very strongly. It's tracking almost 13,000. Yeah, and also on the right-hand side, very hard to see, but industrial production spiked up. So these are very robust conditions again for Singapore economy. Next slide. Then this is just the banking sector. It's not skyrocketing, which is good because you cannot have loans skyrocket too sharply. Otherwise, you got NPLs will come about. But it just shows that it's very healthy activity in the banking sector, which is the loans is doubled last year's 2.7 same time. and deposits are still very ample. So how to read this is that the last 12 months, we collected 154 billion deposits. This is double the same period last year. So deposits are actually rising quite sharply also in Singapore. So this is healthy for the banking sector. Next slide. So okay, this last time before to so this is just on the where the market is pricing interest rates. So this the blue line is the market expecting. So the market expecting one more rate cut, 83% probability. Of course, all these changes, but right now it's a high probability. And for 2026, market is looking at another three rate cuts. 27, nobody knows. So of course, this side go sideways. But then the green line, as you notice, the green line, which is the 2-year bond yield, seems to be quite a good predictor. So you look at 2021, the market already expecting a increase in the Fed funds. So you can see the green line already turned few months earlier. So right now, the 2-year bond yields are looking at 3.5, so which is consistent with one rate cut coming up. And we think the rate cut will come in too because I think the Fed will be a bit worried to kind of upset the market. So everyone is predicting rate cuts, and then if they don't do it, it might kind of cause some huge volatility in the market. Which that's why I think the Fed will also kind of follow where market expectations are going. Next slide. So in terms of our review, so every early of the month we will just review how the Singapore market performed. So the market was up about 2.15%, which is the STI, and then year to date is up about 19. The table on the left is just some of the various sectors that perform, the way we classify it. Yeah. So the one that did well, of course, telecom because of Singtel. Banks also were up about 2%. The numbers, the stocks on the top 10, it's just small mid cap stocks, everything. So what has done well has been Sheng Siong, CSE, Marco Polo, or the losers are on the right hand side. And the SPDR means the index gainers are at the bottom and the losers are on the bottom too, just for your reference. Next slide. So this is the performance by asset class. These are all in US dollar terms. So in terms of US dollars, it was a risk-off month if you just looking at this performance. So Nasdaq was the weakest, followed by Asia. Asia Pac ex Japan was the weakest because this includes China. But Nasdaq was weak, and then gold ETFs was the strongest. So I guess it's a risk-off environment. REITs also were softer a bit. Excuse me. Next slide. Then these are the local currency performance by the Asian market. So South Korea was up 20% in 1 month last month, but this month is just consolidating because tech is down, and then Southeast Asia recovered. We also included next 50 here. If you look somewhere in the middle above Hong Kong, it's called NTR. So it's net total return. Although for us, the real next 50 should be PR, which is price return, because S&P, even the STI, they don't include dividends. But the media likes to use NTR, so I mean it's not apples to apples, but never mind. So NTR will give the next 50 better performance, but just something to note because it takes into account the net dividends. Next slide. And this is our model portfolio just for reference. We were basically flat, 0.7. Singtel did well for us, but then Geo was down 8%. The data on the right, just again, all this just for reference. And we were up 38, and then markets up 19.5. Next slide. And this one's sorry, very small. I'll try to shrink it a bit, but this is just our EQDP small mid cap stocks that are below 1 billion in market cap, just for reference. Okay, thanks everyone. You can move on to Q&A. Thank you.
Hey, thanks, Paul. Yeah, so let me take on some of the questions first. Quite a few questions. I think 2 questions on Skylink. So thanks for those. The first one is, who are the competitors of Skylink and what is its market share? Yeah, so competitors, they have, I think the 2 biggest competitors would be excuse me, GoBell and Pan Pacific Van and Truck Leasing. So they don't, I mean, the market is quite, they don't give market share, but if you compare the fleet size, then you can sort of see. So GoBell is around more than 5,000 the fleet size. Then Pan Pacific, they don't have the exact figures, but it's around 1,000 to 5,000. So Skylink is around 1,000 plus. So Skylink, if I'm not wrong, should be the third. They say they are top four, top four to top five. Right? It always shifts. So you can see that the market share is I would say they are about less than 10% of market share. Yeah. Based on just really rough estimates. Yeah. There's no public information on the market share for these companies. Yeah, another one here on Skylink. News say they will be going into a few partnerships. Will that help to perk up the share price? Yeah, so I did, if you listen to what I was saying earlier, they have two new tenders. These are quite big tenders. And one is with a big bus company, like a public bus service. And the other one is with food and beverage, MNC food and beverage company, right? So these two will definitely, they believe that it will help to boost their earnings, especially in the engineering segment, where they do the maintenance, repair, or the MRO, right, for these companies. So you are servicing like 2,000 buses basically, yeah. And then the profit margin is also quite good because they do things like painting and repair, so the cost is very low, and the manpower is also not you don't need so many because it's on a rotation basis. So that's the partnerships I think they are talking about. Yeah, so I can't really disclose the names because it's not public information yet. Yeah, so these two new tenders will basically really help to boost their engineering segment. Yeah, and I guess in fact if it boosts their earnings as well, this will also help with the share price. Okay, yeah, two questions on JP Morgan's target price. They upped their target price on DBS, right? It went up to 70. So for those who don't know, JP Morgan, I think they upped the target price for DBS to $70. The questions here are, will that be too overwhelming at their price tag? And also another one here from Ian is it extreme optimism or simply a case of pump and dump by institutional investors to trap retail investors? Yeah, I don't really comment on that, but we comment on our own view. So our target price is $58, right? We'll keep it as that. I think you can take what you can draw your own conclusions from our target price. So we believe that DBS is definitely the strongest Singapore bank, right? That's our top pick amongst the Singapore banks, from deposit growth, them being able to manage their margins by hedging and otherwise, and also by their fee income growth is also very, very sustainable, right? Which has helped to offset some of the decline in the margins. And most importantly, like I said, the dividend yield is also the strongest amongst and dividend payout, and their outlook, their guidance, it is the strongest amongst the three banks. So that's why we believe, DBS is our top pick. Yeah, but in terms of the target price, yeah, ours is 58. So yeah, I don't want to question their logic also behind how they came up with $70. Okay, let me see whether there's any other questions. Yeah, one more on the DBS one again. Is asking, but with rate cuts, it will dampen bank shares, isn't it? Yeah, so I don't think it's just the rate cuts. Like I said, the rates, they're managing it by managing their deposit flow. So their deposit growth is the strongest amongst the three banks. And also, they do a lot of hedging, which helps with managing that NIM compression. And also their fee income is really helping to offset. Because if when deposits go down, yes, their net interest income and margins will go down, but fee income, if they are able to, they will actually help to offset that because growth will come from fee income. And loans is also growing because of the lower interest rate. And that's one side of it. And I guess the other big part of DBS will be the dividends and how they're returning so much of this excess capital. Yeah, and maybe one more thing before I hand it over to the rest of my colleagues, it will be the that they have a very big sum of management overlay in terms of provisions and allowances, right? And I think they're the only bank that says that they will write it back if there's a possibility to write back. The other two banks don't say. I mean, UOB just put on more, and then OCBC didn't say at all. So I think that's also one of the reasons why DBS is the topic amongst the three banks. Oh yeah, so yeah, one on the US big cap bank. So we do cover the biggest three. I think moving forward now we will be looking at Wells Fargo because of the asset cap removal. So their growth wise will be the fastest amongst the three banks because there's suddenly you are looking at like being shackled down, and all of a sudden because of the shift in the regulations and them allowing it's like you suddenly can run, right? Previously they were only really being able to walk, right? Or brisk walk. But now with this being unshackled, right, it really will help them to grow their asset base, their loans, and this will help to grow basically every part, every aspect of the bank. Yeah. Yeah. Okay, I think that's all for me. Let me hand it over to the rest of my colleagues. Thanks.
Thanks, Glenn. I can take on some questions. Yeah, I think there's a loaded question on Sembcorp, Centurion, and LHN. But I think I'll just answer the Centurion part and leave the question here. Yeah, so for the fair value of Centurion is at 1.8 now, 1.81. So there's still significant upside now because my view is that the I think after the REIT spin-off, Centurion's balance sheet is much healthier. And in the most recent update itself, they have announced their pipeline going forward now. So going forward, we think that 2027 will be their growth year because there's a 70% increase in bed capacity in Melbourne, in their Melbourne PPSA. And they have also recently entered into a new segment of managing worker dormitory. So we think that will increase their margins. Yeah, so I think that's the main story for Central now. It's a long-term growth story because management is remains the same despite the REIT spin-off, and we think based on the management track record, they are able to find growth opportunities early. Yeah, so that's our view on Central. Yeah, I think there's a few questions on BRC Asia. I'll just leave the slide over here for now. Yeah, so there's a question asking me to repeat the salient points of BRC. Yeah, so for BRC itself, I think the main growth driver will be in terms of project offtake because because of their very strong order book. We think that the volume of steel rebar delivery will still continue to ramp over the next few quarters. We think that 2026 to 2027 will be a peak year because of the huge amount of contracts incoming for over the past few months. So we think that as the contracts start being tendered out, there'll be a few quarters of like preparation and lull period before the project actually start getting executed. So that's why we think that BRC will eventually benefit from this ramp in terms of project execution. Yeah. Hope that answers your question. I think there's another question on BRC. Why did I mention lower steel price is a negative to BRC? Yeah, in your point of view, it should be a blessing as lower steel price can give more room to BRC to manipulate market prices. For example, it can lower market prices just by a bit to seize out market and make even more profits due to lower prices of steel. I think you may have a point. Because BRC Asia right now is ultimately the largest market player in terms of steel rebar lah. So I think there's some room for them to play around with the market prices. But I think in terms of why is it a negative to BRC Asia for lower steel prices, mainly it will affect their top line because it will drag down revenue. Secondly is because I think in our most recent meeting with their management itself, management mentioned they are seeing more competition in terms of the steel rebar space, because as the construction activity in Singapore start ramping, there's a lot more entrants starting to come in. They are seeing more entrants, and because of these lower steel prices, the competitors can source for steel rebar more easily. They can get financing for steel rebar. I mean they don't have to finance that much in terms of buying up their inventory. So that's why in the medium term itself, if there's I mean in the short term itself, if there's more competitors, it may affect BRC Asia's margins. But currently we are still not seeing that. So right now it's still not a big negative. Yeah. Hope that gives some clarity. Uh yeah, there's a question about WeHer. They recently issued notes at 4% or so. How would that impact its mother share price, if any? Yeah, so for the most recent notes issuance, there's no additional shares clause being included. So we don't expect any share dilution, and hence I think fundamentally we don't expect it to impact its mother share price. I think historically, after we heard issued notes, there's not much impact to its share price. Yeah, yeah, we think that this note issuance is just for them to raise more cash for future project development. Yeah, not that it will impact its share price significantly. Yeah. Yeah, I think that's all from me for now. I'll hand over to my other colleagues. Thanks.
Yeah, thanks, Iqbal. Let me answer some. Any update on Gokul and CDL PropNex? Sales of new launches has been good. PropNex has been the largest brokerage for all their projects. Wonder why all the property shares decline and rates are going down a few more rounds. Time to stop more. Yeah, so for this, right, our view is that first of all, the share price is down now, but we have to take into account the fact that year to date, Gokulan and CDL both up more than 40%, PropNex up almost or even more than 100% actually. Yeah, so the share price performance has been very good. So it's only part and parcel of trading that the shares will have to, go up and go down. It can't be go up all the way one straight line, right? So that is the trading part. But for the performance of the property sales, um, personally, I'm not sure whether Paul shares the same view. Personally, I think that next year the demand will definitely fall because not definitely. My view is that demand will moderate for new homes. So first of all, because a lot of the demand is still driven by Singaporeans and PR, and the fact that the 3-month SORA is really and the SORA borrowing rates has really fallen to like 1.25. So I think that really drove uh the that's one of the factors that drove the sales in the recent months. And this quarter specifically, three of the developments like Penrith, Zion Grand, and the Sky at Holland all had very strong pickup rates, mostly from Singaporeans and PRs. So that was like over 80%. And for Zion Grand especially, like it's at 3,000 PSF. So we don't think at these prices the demand will remain that high going into next year. I think a lot of it is perhaps pent-up demand and the fact that some of these launches, like they were in locations where they have not seen any new supply over the past 7-8 years. Yeah, so going forward, I think the demand might start to moderate. Yeah, I mean that's just my view. Yeah, I will leave the question there in case Paul wants to share his views as well. Yeah, thanks. We answer. Uh, okay, next one. Can Far East Orchard be compared to LHN, Centurion, and WeHer? Yeah, so there are some similarities for sure. Let me just try to compare them based on their business operations. Like for Far East Orchard, they are more of a lodging platform with a little bit of um intention to venture. I mean, they have a small development PBSA fund, but they have intention to venture more into that. or increase their fund management exposure. So FEOR, they are more hospitality, lodging, PBSAs. LHN is more co-living, self-storage, industrial. And Centurion is more Centurion and WeHer are more purpose-built worker dormitories, PBWA. A little bit of PBSAs as well. So yeah, there is some overlap. Yeah, for the business operator. So yeah, you can compare them, but it's might not be a like for like comparison. How's the asset light policy of Capital Land Invest getting on? CLI has totally missed the whole STI run. Yeah, so they are transitioning to more capital or asset light. So they're planning to divest more of their balance sheet assets. If I'm not wrong, off the top of my head, they still about 3 billion. So a lot of it is like 50% of it is from China. So they're trying to divest or recycle those assets, perhaps seed more funds from China as well, using those assets. So they are still trying to definitely expand their FUM and divest their balance sheet stake and increase the F or the fee recurring income streams that they have. But you are right that they have missed the whole STI run. But if you look at it positively, I think a lot of the fact the reason why it's missed is because the divestments and the growing of FEM has been slower than origin or rather the market anticipated or expected. So that's probably one of the reasons why it has not run. But if you look at it from a different perspective, is that since it's one of the stocks that has yet to run, there is more potential for it to run because of when the things turn and they actually start to meet market expectations of increasing the FUM, the pace of FUM expansion and divestments and seeding new funds. Yeah, as the FPM business continues to grow and fee recurring income continues to grow. So I think there is still a lot of potential for CLI. Uh, I think I saw one more. Yes, sorry, I think it's jumping. Yeah, few past and present web sharing indicate positivity on hospitality sector, including Escort. But the share price doesn't move much at all. Please comment. Yeah, so for Escort, right, we are positive in the fact that they are very diversified. So they're one of the most diversified players in hospitality REITs as listed on SGX. So okay, the share price doesn't move at all. So first point is that they've indicated that they will have stable dividends, so 6.1 cents for this year, and in fact they indicated 6.1 cents next year as well. So if you look at current share price, that will give you about a fixed yield of about 6.5%, based on the guidance that they will, if in case the absolute DPU falls short, they will top up using previous divestment gains. So that is point one. And for the operating performance, Escort has slightly over 10% of their income from Singapore. So Singapore is a market that we think is kind of weak. And next year as well, the hospitality outlook is not, I wouldn't say spectacular, but there are some positives, like there is some major events, and like there's a Singapore Air Show as well next year. So all those can help to boost the RevPAR number. So it definitely won't, you won't see like just 2023 kind of double digit RevPAR growth, but at least I think a single digit RevPAR growth would be likely for Singapore. So we think the hospitality sector still can perform better in Singapore, especially with hopefully international visitor arrivals by then, by next year, can recover to at least pre-COVID levels. So this year the target is, or rather is looking more towards like the 90 to 95% of pre-COVID levels. So with more visitor arrivals also, that can help to increase the exposure. But for Escort specifically, they are very geographically diversified, like I mentioned. So a lot of the other operations are performing still very resilient, like Japan, France as well. The master leases still performing well. UK, US as well, still performing well. Yeah. So all in all, can say that better performance in other geographies can help to offset some kind of weaker or softer demand that possibly might be seen in Singapore. Like especially this year, Singapore relatively weak, but next year, yeah, hopefully there is a recovery. Yeah, so that's my take. Yeah, I think I'll hand over to my colleagues now. Yeah, thanks.
I'll answer some questions about Zixin. I saw the questions say I own the share bought via Poems, didn't receive the share buy option. Yeah, and I just want to let everyone know that this placement is only available to a certain investor. Currently is mainly for the major shareholders. And then the second question is there seems to be a frequent equity calls or placement salient risk for minority shareholders. Yeah, thanks for the questions. I would say that in terms of risk, maybe the dilution might be a risk for the minority, but at the moment, I think the main purpose for the placement is to raise the capital for the upcoming project, especially in Hainan. And also thinks that the major shareholders the exercise of the option actually shows that they do have a commitment for the long-term growth. So yes, there will be the risk for the dilution, but they also have some opportunity for Zixin's long-term growth. And at the same time, I do believe that Singapore market is pretty active right now, even for a small cap company, because of the high expectation in liquidity. So maybe a company actually thinks that it's actually a good opportunity to raise the capital since the sentiment is still pretty good. And then I think there's another question. Is Zixin a SOE? What is the max cultivated volume year currently and the project in the future with the expansion mentioned? What is the competition like for their product? Any idea who are their main competitors? Yeah, so Zixin is not a state-owned enterprise, but the overall sweet potato industry in Liancheng is sort of supported by the government policy because they do want to push forward this food security, and secondly, they want to kind of reduce the reliance on soybean import. So in Liancheng, there will be some government funded investment in terms of like drainage system and also like live stream center and all, in order to make sure that the entire transaction process is being streamlined. But Zixin itself is not really a state-owned enterprises. And then the max cultivated, I think it's estimated to be around like 35 tons and above. Moving forward, the volume, the high-end production could come from, the first thing is that I mentioned that in Liancheng, they're expecting to expand 100 mo of land for this seedling nursery. Currently it's 200 mo. So it might expected to maybe like increase of 50% of volume. And then the long-term basis is from the Hainan project. So the company currently is under negotiation to have like 10K more of for this seedling, but they won't do it one shot. They will do it once they have the land. They will do it on a slowly basis, and we estimated to start maybe like around 500 more. But at the moment, I couldn't really provide an exact number of the cultivated volume, but that's what's the expected expansion in terms of the productions coming from. And then they don't really have a direct competitors because they have a integrated value chain, as in like I mentioned it in the update. They do from seedling to waste recycling, but in terms of competition, I do think that, specifically maybe for processed product segment, of course, they will be some of the competition, but then most of it are like local brands like sweet potato, local brands of the companies that actually produce some of the sweet potato snacks. So that's what's the competitions. Yeah. And then anything else? Yeah. Um, oh, the target price for Zixin is 0.055 at the moment. And then so is it considered as a low liquidity counter? Yeah, based on the price movement, currently it is, but I think there's still I mean liquidity in it. It's just that the movement of the pricing doesn't really move that much. Yeah. Any other questions? Yeah, I think that's all for Zixin. Thanks very much. Pass the time to next colleague. Thanks very much.
Yeah, thanks. Thanks, Lynette. So let me just address some. Thanks everyone for your questions. What is your view on UltraGreen.AI IPO? What's the fair value? Okay, yeah. Any analyst that says they know much about this UltraGreen is quite questionable because most of us are actually generalists, and for us to have a deep understanding of the technology is going to be a bit of a stretch. So I don't really have a fair value, but I think the next 1 year at least, I think the outlook looks good. I think the most recent results, the earnings growth has been I don't have it exactly, but probably like 30-40%. So I think the momentum is still there for them. And I think the market is still excited about their ability to go outside of the core procedures that they're doing now, which is for colon, gallbladder, and eye, which is yeah. So I think that there's optimism there, and they are global products, so they are all over the world, and they kind of became like a standard for surgery. So and they got high margins, so I think they are getting a lot of attention by fund managers are looking at the kind of cornerstone. I think each cornerstone pop was about 25 million. So this is a big. It's getting a lot of interest anyway. So there should be a lot of excitement for this stock during IPO stage. But like I said, I have no idea how to assess the technology, whether it works. Because there was another question, Paul, you mentioned the fluorescent dye injection into the body. Very interesting, but I think it's a ticking time bomb. Before someone may discover this can do more harm to the body in the long run than anything else. Just my 2 cents. Yeah, I do not know that part. I mean, yeah, but they claim that there's a lot of studies. So there's a lot of studies supporting their product. That's how they get the surgeons to almost become like a KOL for their products. So they are very good in getting the associations to endorse it, entering into the curriculum for education. So it's a very intelligent way to market the product, to make it like a compulsory. And if you don't, then any issues with the procedure, then you get ready to get sued. Yeah. So if you use this, at least you know you're following the standard procedures. So it's a very intelligent way to make their product a standard in in certain surgery procedures. I think that's my own understanding. Yeah. Sales of new launches has been good. Wonder why all the property stocks. So just to follow up on Darren's question. So for PropNext, I think there's no issue on PropNext fundamentally, but I think at this stage, if you use 11 cents, I think for PropNext you can assume like a 10-11 cents EPS. You're talking about 20 over times PE right now. And as you know, property volumes at least can be cyclical. So I think market is just a bit wary whether can this type of volume growth persist. And because you're worried what the authorities might do. I mean, if the market is too hot, they could impose some cooling measures. So I think the market could be pricing in some cooling measures. This may not hurt CDL Gokuland that much as PropNext. PropNext is a pure, new home sales is one of their major, or property units is one of their major earnings driver. Where CDL and Goku, no, they have overseas operations. They got investment, property investment. So I think this market will just be a bit worried about 2026 ability to grow. Yeah. For us, one thing that can help offset for Propnex is the resale has been weak so far. So if new home sales are soft, then if resale recovers in 2026, that could help sustain their earnings. What will happen if Sembcorp does IPO Indian unit? How much this Indian unit contribute? Noted Centurion went up. Yeah. So for Sembcorp Industries, I think the market is worried about the second half results coming out. I think any Indian IPO probably going to be next year. I don't have any working numbers, but I think India renewables for easily 20 or times PE, so that will cause the big or some re-rating. So for Sembcorp Industries, the worry on the earnings for second half is the margins. So 3 years ago, their margins could be, I'm just pulling a number, $80, and then right now could be $20. So there's going to be a repricing of all the margins for their electricity business. It's collapsed because $80 was exceptionally high, so now it's just going back to normal. And also, they are probably going to make some losses on which they highlighted in their renewables business. Sorry, for the importation of renewable energy from Malaysia. So I think they highlighted that they're going to have some pain on this on this importation from Malaysia. My guess is that maybe they cannot get all the certification because no one knows how much it is actually renewable when you import energy from Malaysia. So probably that is loss making for the next 2 years. So I think that could hit their earnings in the second half. I think there's some risk to my numbers at least. What's the fair value Centurion Alish N now? Okay, let me give you better numbers because Alish N is only going to do a briefing on Friday, so we will definitely come up with a report on Alish N on Monday, so I can give a better color on it. But for us, we still like the co-living franchise. I mean, it's one of the fast-growing accommodation franchise that they are doing well. So they've already secured pipeline of about 30+% of pipeline new capacity coming in. So this will support growth at least the next 1-2 years for Collywood. Could you provide PE in the equity analyst slide? Yeah, thanks for that. Yeah, I didn't include because there's so many columns. So maybe for the EQDP hit list, we will put the PE ratio for you. Yeah, thanks for the suggestion. Please comment on ST Engineering future growth, contracts book, and dividend stability. What's the target price? Yeah. So my target price is 820 for ST Engineering. We downgraded it to a hold, I think, few months back. Nothing wrong with the business. It's just that the valuations was just very rich for us, about 30 times historical. So we will revisit our valuations depending how we see the 2026. But for right now, it's 820. But the outlook is strong. I think defense. But if there is a Ukraine peace deal, you could see a bit of weakness because then the market might derate a bit on defense stocks. Yeah. Also, there was another question. What is the key driver for ST Engineering stock price sinking last week? My guess is this Ukraine deal. I think the share price probably has to get over a peace deal in Russia. Again, I have no idea whether it's going to happen, but if it does happen, then I think like I said, the whole defense industry might de-risk a bit. Maybe you don't need so much ammunitions. Countries may not want to stock up that much. But that is the short-term impact. But the longer-term impact is, as we all know, Europe is going to raise their budget on defense. Number one, and then number two, a lot of the European contractors are filled with their capacity. They don't have enough capacity, so that's why they are going to Singapore companies, which I think such as ST Engineering, to supply weaponry, arms like the Terex, the Bonkos, the mobile vehicles. So that is where the demand's coming in. Hi Paul, any upside for Jardine Group? Okay, I don't really follow Jardine, but I guess some commentary I've heard is that everyone's looking at Jardine Cycle and Carriage now. The price is a bit softer because of the impact of Astra, because Jardine Cycle and Carriage is essentially Astra International from Indonesia. But Astra is no, the under pressure from BYD. I mean, every car industry in the world is impacted by BYD. But I think the view is that no, Astra has a lot of assets and they might kind of monetize some and they might benefit second and carriage. But again, I don't study this closely, so let's take it with a bucket of salt or pinch of salt. Yeah. Do you expect the usual year-end Santa Claus rally or some pullback? My feeling, if we don't get a rate cut, there will definitely be a pullback because if you a typical behavior of a fund manager, assuming they done very well, especially for Singapore, the market's up 20%, some stocks could be like Propnex up double, some 40, 50. You want to lock in some gains, I think, especially if already 40%, you want to take the risk for the additional 10%, you must lock in some gains. So I think that could have been happening this is my own guess, the last 1-2 months, because Singapore had such a rally. And especially if you're performance based, why take the risk for the additional 10% risk? I think some fund managers might probably have locked in gains for this year, especially coming to holiday season. Yeah. Hi Paul, will the China-Japan spec give us tourists flocking to Southeast Asia? In turn, will this benefit hospitality here? Yeah. So the person to really listen to is the Trip.com CEO, which actually gives a good this I always try to listen to this Jane Sun from Trip.com because on Trip.com you get a sense of where the Chinese tourists are going. According to, I saw her interview on China News Asia, so she actually said that if they don't go Japan, they probably come to Southeast Asia. So if you think about it, Southeast Asia has no, you can go from Thailand, then go to Malaysia. So Thailand and Malaysia, and then last place is probably expensive, Singapore. But anyway, you can actually go to 3 countries and make it like a package, I guess. So she mentioned Thailand and Malaysia in the interview, which I actually asked ChatGPT, but they don't have because ChatGPT don't go through videos. But if you go listen to some of her interviews, that's what she said. Yeah. So I think in Southeast Asia, like what you mentioned, is correct. Current Singapore economic overperformance still doing well, but next year don't look so good. I do not know. I mean next year, but the momentum should carry some at least the first quarter. Yeah. I think next year should still be healthy. You got construction and then export sector, but I can only tell you fourth quarter is very good. I'm not too clear of what is the major driver for FY 2026. Yeah, but so far the momentum is strong. I think. Yeah, window dressing before year end. I'm not sure. Maybe Malaysian stocks, but I don't see that in Singapore. Yeah. Any update on Singpost? So our view is a bit negative for Singpost. I think that we commented. So the market cap of Singapore is about 1 billion. And the biggest asset now is Singpost Center, which is the mall, which is also worth about 1 billion. So I think the price is probably reflecting if the asset. So the unknown right now is the loss. So Singpost has the mall, has international parcel, which isn't doing well. The earning is turned to loss making, and of course the whole Singapore Post Center. So in the end, it all hinges on on the review with the authorities, what they're going to do with the center. So if they as a positive review, so either the authorities maybe raise postage rate. I do not know. I'm just making this out. Either raise postage rate, either um take back or pay them, allow them to close some of the Singapore center postal centers, or maybe compensate them better. So the Singapore share price all depend on the regulatory review. Apart from that, the stock don't look interesting for us. Yeah. I think after the sale, the special dividend, I think the share price might be a bit sluggish for us because there isn't really major catalyst. And if you're relying on authorities, my understanding is that they might not give out any major subsidies or anything for them. So I think the share price might be a bit soft. Comment on SIA. Yeah, sorry, our analyst Hashim is not here, but I think he has a neutral rating on SIA. Yeah. Because I think the India losses will probably continue to drag the earnings, and we don't see any improvement in the pricing or the SIA yield. But I think that's his view. Sorry, I don't give a very good answer to that. Do you expect market correction, black swan event due to US government policy shift? I don't think so. I think it might be a positive as we head into the midterm elections. So as we head to the midterm elections, I think Trump has to turn more positive on the economy. Yeah. I'm not sure what's he gonna do. Maybe to do the 2,000 subsidy. I do not know. But as the midterm elections come, he probably have to tone down. He has to push inflation down because cost of living is the big issue. So, Black Swan, I'm not so sure. I don't. I mean, if predictable, I wouldn't tell you to. But anyway, we think 2026 could be a bit better from the US political standpoint because of the midterm elections. Can you flash the week 49 macro view again? Yeah, can someone flash that? The whoever's controlling the slides. Yeah. Yeah. Okay. Yeah. Thanks. Can for prop next any possibly a rebound as the price is dropping? I think as it comes near to the earnings that could rebound because they probably going to announce a special good dividend or special dividend and the earnings going to be spectacular for them. So as the earnings comes around, yeah, probably in near end February, mid to end February. Yeah, so uh, Keppel TA is quite far. Target price, you mean? Possible to advise the timeline? Okay, our target price is 12 months. And yeah, it's quite far from now, but I think give it some it already done pretty well this year, but we think next year will be the year they need to monetize some of the assets. I think the monetization of assets and of course share buyback they're doing now. So the monetization of assets will be the big driver, and of course earnings growth. So we think earnings will be strong, especially when their new power plant gets on stream in the middle of next year. So these are the two drivers to the Keppel share price. I think you meant TP target price. I mean, yeah. So I think next year these are the two drivers. Okay, can go continue profile upwards. Any guidance for target price? Yeah, I think that one more technical, but I think for us, our general view when we initiated CNMC Gold Mine wasn't because we had such a super strong view on gold. Not that anybody want to listen to our gold view anyway, but we just like CNMC because we saw production was rising. They're raising capacity. So at least we got that covered. They were going to grow capacity production by 40%. Probably this year another 20%. And for gold, the outlook's still positive. I think if the Fed cut rates, then gold has to rally. Otherwise, then there's some technical then the price action not doing well. But I think gold still looks positive because interest rates are coming down. And I don't know, based on my latest collection of the data, China continues to buy gold. And if you assume China wants to become the second largest holder of gold, there's still at least another 200 billion worth of gold they need to buy. Because I think they are now the fifth largest holder of gold compared to Germany, which is the second. Geo Energy, any outlook? So we are positive on Geo, especially as we go into 2026. As we come closer to the completion of the road, then I think you could see a few catalysts of them selling a stake in the infrastructure. And like I mentioned, of course, getting off-taker. But I can understand the market being hesitant because this is still Indonesia and the road hasn't completed. So I think the market will still be very hesitant until the road's completed. So that's understandable. So I can understand why market won't price totally the completion of the road because Indonesia, right? Until it's completed, 99% isn't good enough. Yang Zhejiang Financial Holding under upside, yeah. I I'm not positive on Yang Zhejiang Financial Holdings because their loan book is still 40% NPL, and I don't think China property market is improving much over there. So, and my theory is that there must be a reason why they demerge. Maybe now they get the healthier part of the business, yeah, which is the maritime. Maritime looks a bit more interesting because that's where Yang Zhejiang's strength is, which is securing opportunities in the marine sector. Yeah, finding opportunities to finance vessels, to buy vessels. It's almost like a hedge fund in shipping, which they have the long 20-year track record for that. Do we know if the new home sales is mainly driven by PR? I don't have the latest data, but for new home sales, what the property agency normally say is citizens. New PRs normally buy the resale HDB. then they will then move on to new PRs typically buy. Again, this is not like every PR, but largely new home sales is done by Singapore citizens. And the another demand is there is a transfer of as kind of legacy planning too. So a lot of people buy for their kids. So yeah, so that's one of the issues. Yeah, that's one of the things that's happening to a lot of people, like a wealth transfer too happening. A lot of parents buying for their kids. Yeah, of course not my parent, but any other parents. Propnex one, the top loser. What is the real cost? I think the valuations that we mentioned, Propnex is really trading at 21, 22 times PE, and also people are just wary of intervention by yeah, any cooling measures. I guess that's the worry because the market is just too hot. Yeah. Okay. Can you advise Sembcorp shares is still possible to dollar cost averaging from its high? I will wait until the results. I think, like I mentioned, I'm not expecting strong results for Sembcorp, so I think I'll probably wait until to do the DCA dollar cost averaging. I'm assuming, yeah. Okay. Propnex, the next quarter should be stellar given the sales. And they have no debts and pure earnings with good dividends. Think I may use some bullets there. Yeah, I think yeah, if you're playing for the results, it'll be like amazing. Yeah, it's like yeah, and if you track the fourth quarter home sales of this year, that means industry sales, that should help their 2026 numbers. Yeah, because new home sales, if they sell today, only recognize as earnings 3 months, 3 months later. Yeah. What's the standard deviation for STI now? I think it's at the average level. Yeah, sorry, I didn't show the chart, but it's within the average, about 14 times PE right now. Okay, I think I'll leave it to the rest. Okay, what's the outlook for venture and the current price? Yeah, so venture for me, obviously it was a bad call. I had a neutral rating because I saw earnings coming down for the whole of this year. But of course, the share price has outperformed. It's about 18 times PE now. My target price is I think like $13 or some or along those lines. So I just thought that venture not the time now, although they're giving a 5% yield. Because the earnings is down, especially without the Philip Morris kind of contracts weakness. So I think it's more a second half 26 story where we think earnings can recover. But obviously wrong. I mean, everybody started piling into venture. And let me answer this last one. If I didn't hear you correctly, you mentioned there will be a market recovery for ThaiBev next year onwards. Care to confirm, elaborate? Yeah. So I'm not expecting a revenue recovery for ThaiBev because because okay. So what happened is when the Cambodian workers left because of the border dispute in September quarter, they're not going to go back in December. Everybody rushed back in, although they need the job. So you can assume they will trickle back into Thailand. So the impact of the border dispute of workers leaving is you're going to feel it the next 2 to 3 quarters. So revenue will be impacted. But my view of the recovery, not to mention there's flooding, I think in Thailand too, and also in Vietnam. But my recovery is mainly on margins. So ThaiBev is known to be very aggressive for cutting OPEX when revenue is weak. So that is one lever, and margins. So gross margins are definitely going to climb, even though volumes is not there, because across the board, all their raw material cost is coming down. Like I mentioned, corrugated costs, aluminum cans, plastic, malt, which is used for beer, molasses, which is sugar, which is used for spirits. So they mentioned everything is down double digits, some as much as 20% down. So mine is more a margin recovery that will help them grow their earnings. Yeah. But I know I'm not talking about high teens. I'm talking about maybe my number is, I think, high single digit recovery in 2026. Yeah. Yeah. So sorry for the long answer. Yeah. That's what I meant. Yeah. Okay. I think I'll let the rest answer before I come back in. Yeah. Thanks everyone for your questions. Yeah, and for your patience.
Thanks, Bob. Yeah, let me do the UOB one. It's asking, can we expect improved earnings for UOB going forward after their huge provision for third quarter? Yeah, good question. It's just one of the factors, that they had the weakest performance in the third quarter. So even if you add back that provision, right, their performance was still quite bad, quite poor compared to DBS and OCBC. The main thing that we saw that affected them, I mean, besides of course that huge provision, was their fee income growth is very weak, right? It was down actually by about 1 or 2% compared to the other two banks, right? We are seeing double-digit growth in fee income, which is helping to buffer the decline in net interest income, and that is to be expected. But for UOB wise, instead of having an improvement, they actually declined slightly. So the reasons, was that there was some unforeseen expenses in terms of the rewards in Thailand, and but then you look at the previous quarter, it was also very weak, right? It was like low single digit kind of growth. So the even after having that growth, the acquisition in ASEAN, right? The main reasons are because a lot of their customers that we believe a lot of their customers are more prudent, so they're not really putting their money to use. Instead of placing it into insurance as an investment product, they're just wait and see, because they're a bit I guess worried about the whole volatility. So they are quite risk off. So that's why they just put it back into a fixed deposit, even though fixed deposit gives you 1+% kind of interest rate. Yeah, so that's the main reason. And I think if they can fix that and also grow, their ASEAN business and maybe fix a bit of their expenses, then we will probably see improved earnings. But if you're looking at quarter on quarter, which is probably not the best way to look at for 4Q, then there will definitely be an improvement because of these huge provisions. But year-on-year wise, I think they will continue to see a decline even after they settle these provisions, because they just need to fix their fee income growth, which is not working out whatever they're doing now. If you're comparing to the other two banks. Yeah. Okay, I'll leave the rest to the rest of my colleagues. Thanks.
Yeah, thanks, Glenn. Yeah, answer one more. Why are analysts positive on retail REITs? RTS restaurants closing down, tourist arrivals not as good. Yeah, so first of all, tourist arrivals this year, although not as originally expected, like to return to pre-COVID levels by this year, it is still showing some year-on-year growth in the low single digits, if I remember correctly. So the outlook for next year is still possible that it will go back to pre-COVID levels. So that's on tourist arrivals. Yeah, next on the RTS. Yeah, so the RTS, there's a capacity of about, if I'm not wrong, is 10,000 capacities per hour in each direction. So when that comes on board, there is this KTM shuttle train that's currently in operation. So that one has about 10,000 passengers per day. So once the RTS comes on board, this KTM will be phased out or will cease operation. So it is a plus for the RTS new capacity, but then again we'll have a minus from the KTM. So it's not just a pure add. So that's another one. And the fact that the Sing dollar against the ringgit is the exchange rate is now 3.19 as compared to like back then 3.5, where a lot of people were going there to shop. Now when the exchange rate is lower at 3.19, 3.15, less people might go to Malaysia to shop. And the fact that the prices in JB is also rising much faster as compared to Singapore. And when you take a look at, you do the comparison with exchange rate and such, the actual gain you get might not be that much higher, or might not be that attractive. And the fact that if you do take the RTS to do grocery shopping and buy stuff there, and take it back, I'm not sure how many of you actually buy a lot of things and have to lug all your groceries and whatnot back to Singapore through the RTS. I think those who are already doing those grocery shopping usually drive in. Yeah, so yeah, that's on the RTS. But generally retail REITs, the supply is also not a lot. Like based on current estimates, about 2.4% of the current retail stock we have of new supply, basically 2.4% of new supply of the current total retail stock over the next 3 years until 2028. So that is quite limited. And also the fact that there is a long queue for overseas retailers to come in as well. So even if currently let's say like a restaurants or whatnot closed down, there is a huge or long queue of overseas F&B outlets like from China, etc. to enter. And on top of that, previously the hype was more of the Chinese F&B, but now also there's also uh, China wellness, beauty and wellness, like all your makeup brands and whatnot from China coming to Singapore as well. So that's also another boost of demand for retail space, especially in the malls. Yeah, so overall, occupancy cost is also still generally below pre-COVID levels. So and it is still sustainable for rents to increase. Yeah, so yeah, that's why generally we are still positive on retail REITs as well, as we think there is potential for positive rent reversion to maintain at least in the high single digits next year. Yeah, that's our view. Yep. Okay, I'll hand over to my colleagues. Thanks.
Yeah, thanks, Darren. Yeah, there's a question. Are the AI and semicon approaching the bubble phase as some stock market gurus sounded out the warning? Or are they just another alarmist? Yeah, I think I will try to take on this question from some angles. Firstly is from the more general angle. So if you look historically, based on the dot com crash, from the timeline that Netscape was introduced, that means the www.com, that one, until the dot-com crash in 1998, it was 6 years. So it took 6 years for the demand to slowly come in, then for people to start speculating, for the bubble to start growing before it actually popped. So right now, if you look in today's sense, ChatGPT just came out like 2-3 years ago. So I think we are still quite early in this AI phase. Even if there's a bubble, my opinion is that uh we are still in the early phase. I think another angle we can look at is some of their claims. So I think some of them claim that for example, AI GPUs, uh the hyperscalers are stretching out the depreciation number of years. So they may be inflating their profits itself. But in the most recent earnings call, NVIDIA CEO Jensen, he disputed the claim. He mentioned that uh, the previous generation Ampere GPU, which was released 6 years ago, is still fully utilized because of NVIDIA's CUDA software ecosystem. So it is able to support uh, the the Ampere GPU hardware. I think if you want to think about it, I personally can think of it in the perspective of like a laptop. For example, you use for 2-3 years, but of course, if there's newer models coming up, then you want to change laptop. So in reality, you may not really use for like 6-7 years, but I would see this as a stronger demand because if there's newer models coming up for newer laptops, then it indicates that there's a stronger demand in terms of the AI workloads being utilized. That's why I view this as a positive because when people need to change and renew their machines, it shows that the demand is there for the AI workloads. Yeah, so I think the point about depreciation is can be disputed this way. I think another point that they point out is about the circular financing, whereby, for example, NVIDIA, they have some deals with OpenAI, handing them over $100 billion and then in turn, OpenAI will build their AI capacity with NVIDIA's GPU. Yeah, I think that presents some risk because it's sort of like you handing your clients some money for your clients to buy back your products. But I feel that at this point in time, it still makes up the minority of the organic demand we see because I think the entire demand, if we look at the demand for AI GPUs from NVIDIA and AMD, we still see a lot of demand from sovereign countries. For example, Korea, the UAE, Europe is also building up gigafactories. Yeah, so I feel that we are still in the early phase. Yeah, so I don't think that uh the bubble, even if there is, will pop soon. Yeah, I think there's room to grow. Yeah. Yeah, there's a question, what is the TP of or fair value of Hong Leong Asia? We don't cover Hong Leong Asia. Um Recently in their most first half results, uh their most recent first half results, they did quite well in terms of profits. I think their profits increased by about 15%. And this is being driven by stronger demand for their uh what's that generator sets. Because generator sets are like backup electricity for use in data centers as well as hospitals, because they need electricity to run 24/7. So Hong Leong Asia is seeing this spike in demand for their generator sets. And another thing is they are also seeing demand from their end market in Thailand itself, because Thailand is also ramping up the building of trucks. So as Hong Leong Asia sell out their diesel diesel engines through the OEMs to Thailand itself, they are also seeing more demand. So that's 80% of their revenue segment now. So in terms of diesel gen sets, in terms of diesel engines, um, but in terms of ready-mix concrete, which makes up for 20% of their revenue, um, Hong Leong Asia is facing some short-term headwinds because some of their JTC lease is expiring. So they are seeing some supply constraints in the short term because in the ready-mix concrete space, they are trying to consolidate the the land for ready-mix concrete into the Jurong port itself. So consolidating of building materials over there. So right now, Hong Leong Asia is facing some short-term supply headwinds in that segment. Yeah, so I would think in terms of investing in Hong Leong Asia, if you want an exposure into the construction space, I would say BRC Asia or Pan United would be a better play because they are more pure play. Like almost 100% of their revenue is raw material. For BRC Asia is steel rebar, for Pan United is ready-mix concrete. Whereas for Hong Leong Asia, only 20% of their revenue is ready-mix concrete. Yeah, so uh, hopefully that gives some insights. I think in terms of the PE valuations, Hong Leong Asia also trades at slightly premium, at a slight premium compared to other building material companies. They are trading at about 16 times PE. The average is about 13 times. BRC Asia is trading about 11 times. Yeah, so that one is still undervalued in our view. Yeah, there's a question about Meta Optics dual listing in Nasdaq. Price has been pushing higher. Any comments? Yeah, sorry, we don't cover Meta Optics, but I think I just did a brief search up. They manufacture some Meta lens and glasses for in terms of semiconductor manufacturing, like for example the DUV equipment and also some glasses being used in smartphones. So I think there's some stronger demand for smartphones recently because of um of iPhone 17's release, as well as I think in terms of smartphones memory demand, there's been some refresh cycle because of the AI features being released in smartphones itself. So I think from the industry point of view, there's some stronger demand for smartphones, but we are I'm not very sure about their clients. Yeah, so can't really comment on why fundamentally their prices has been pushing higher. Yeah, sorry about that. Yeah, I think that's all from my end. I'll hand over the time to my other colleagues. Thanks.
Okay, thanks. Let's try to wrap this up. Hi, Paul, do you foresee US market correction 20% once Powell vacate the Fed chair and Taco appointed Fed chair? They do some stupid policy move and black swan event occur, US repo inverted. I think that probably will happen if okay, one situation is that let's say we enter to the US enter to some recession, then the deficit spending from the current 6% probably spike up to, I don't know, 10, 12%. Then the bond yields, it become like a UK situation. I know the bond yields in the US will probably spiral. And then you get this very negative feedback loop where you cannot support the economy because your bond yields are so high. You support the bond yields climb higher. I don't think that will happen so soon yet. Because you need some major recession. But I can only see that if you see the 10-year bond yield starting to really surge. If the Fed keep on cutting rates, but 10-year bond yields means the market very nervous of the US government situation. So the one thing to track is the bond yields. So if the bond yields don't riot, it means if investors don't run away, that means pulling money out of the US, then I think this thing can continue. So that's one way to gauge it. Because globally, US is still getting all the inflows. So until that happens, uh, unless there is no more funding for the deficits, government deficits and so forth, then I think you might get this big correction. Yeah. I mean, there's one scenario. Yeah. So strangers are still being nice to the US. So that won't happen for now. Yeah. In the meantime, all this will be bullish scenario for the US market because inflation isn't running away, and then it's causing the Fed to cut rates, and with the new Fed chair, and you should expect even more rate cuts. So it's going to be very positive for the whole market. Of course, longer term not so great. Buying new properties need only down payment, but it's not guaranteed making money in the coming future, and ability to hold also not guaranteed as economy is in flux. Yeah, okay. Yep, I mean, you're exactly right. I think property, I mean, I mean, I'm not here to teach anyone property. Everyone knows more than me, but it's a leverage game, I mean, so yeah. So thanks for that. Yeah. Paul, as you mentioned, the STI now is 14 times PE. How is the standing compared? Yeah, okay. So I just double check. It's about maybe 14.5 times PE right now. Forward PE, the average is about around 14 or 13.6 or 7 times. So it's around there. Probably one standard deviation is probably 16 times. So I think no, if the market rally with EQDP and the liquidity premium coming up, I mean, no, won't be surprised if the market goes to 16 times. So one thing which we were probably going to focus more in our monthly is this liquidity premium. So when you have a equity market there's a domestic liquidity trap in the market, then you will get the liquidity premium like what you see in Malaysia. Because there's a pool of money that cannot leave Singapore. There's always going to be investing in Singapore, which we never had before, which is the EQDP. That will definitely push the premium, or we call it the liquidity premium for Singapore market. Yeah. Okay. Yeah. Thanks everyone. I think we're coming close to 1 p.m. Sorry, Zain won't be here, but he will be in next week. And if he cancels it, I think he actually will cancel the 8 p.m. event. So you won't see the 8 p.m. event. I think he will automatically cancel it. So with that, thanks everyone for your time. Hope it was useful, and wish everyone a wonderful week ahead. Yeah. Thank you everybody, and take care.